In May 2010, the U.S. stock market lost $1 trillion in just 36 minutes. It was triggered by high-frequency trading algorithms that misread the market and launched a massive automatic sell-off. Those 2010 algorithms were restricted by simple if-then rules. Today, systems like Goldman Sachs Marquis and JP Morgan's LOXM process over 200 terabytes of data daily, making millions of decisions at a speed and scale that has moved entirely beyond human oversight. The fear of this complexity is already causing real-world damage. In February 2026, Citrini Research published a memo titled The 2028 Global Intelligence Crisis. It wasn't an official forecast, but it was enough to rattle the floor of the New York Stock Exchange. Even though the report was speculative, shares in Uber plummeted shortly after it went viral. American Express stock saw a similar sell-off. MasterCard rounded out the fallout, with shares dropping between 4% and 6% in a single week. Investors are reacting to ghosts because they know the market is no longer driven by human intuition. We have handed the steering of the global economy to autonomous systems that have the power to move trillions, but no human ability to understand why. To stay ahead, these systems use natural language processing to monitor the pulse of the world. They read news articles, earnings reports, and social media posts in milliseconds. This diagram shows how models like Finbert convert that massive intake of text into sentiment scores. Every headline is instantly graded as a green or red data point, signaling the AI to buy or sell before a human could even finish reading the first sentence. Systems like JP Morgan's LOX use these points to manage portfolios with extreme precision. By training on millions of historical scenarios, the AI flattens out market spikes, reportedly reducing volatility by 25%. Goldman Sachs is now testing agentic AI, autonomous agents that can reason through complex trading patterns in real time to flag misconduct or anomalies that traditional software would miss. On the surface, the market has never been more stable. But this pursuit of perfect AI-driven efficiency creates a deadly illusion. It masks a fragile system where everyone is using the same tools to chase the same signals. This creates a vulnerability called a market monoculture. Because the top financial institutions train their AIs on the same historical data and news feeds, their machines develop identical behaviors. They see the same arbitrage and reach the same conclusions at the same microsecond. This internal complexity leads to the black box problem. Inputs enter, outputs exit, but the logic inside that dark void is so complex that even the developers don't fully understand it. Regulators call this organizational ignorance. If a single AI misinterprets a headline, it doesn't just make one bad trade. As the central node flashes red, it sends a signal to every other identical model in the monoculture. They all pivot to sell at the exact same moment. This synchronized reaction creates an algorithmic selling spiral with no natural human break to stop the fall. A healthy market requires diverse, contradicting human opinions to stay stable. But in a monoculture, that diversity vanishes. A minor digital anomaly can trigger a catastrophic global freefall in seconds. The danger isn't just a loss on a screen. When a monoculture crash hits, corporations react by protecting their margins. The Citrini scenario predicts this market shock will trigger an immediate wave of AI-driven automation to replace expensive humans, driving U.S. unemployment over 10%. When top earners lose their white-collar jobs, their wallets snap shut. This instantly kills consumer spending, the primary engine of the real economy. As demand weakens, businesses don't hire. They double down on more AI investment to survive, creating a feedback loop where the solution to the crisis only makes the unemployment worse. This ripples outward. Displaced workers default on mortgages, and private credit firms that lent billions based on predicted software revenues begin to fail. This leads to ghost GDP. On paper, the economy looks strong because AI tech giants are posting record stock profits. But as this towering digital skyscraper shows, that wealth is isolated. It never circulates to the decaying physical city below. The end result is a structurally broken system where the most productive asset, AI, is destroying the jobs needed to sustain the economy, leading directly to the predicted 2028 crash. While the Citrini memo looks toward 2028, firms like Vanguard and Capital Economics warn the bubble could burst as early as 2026. They anticipate that rising interest rates will finally force a correction in these hyperinflated AI valuations. Federal regulators are now racing to build safety frameworks for this agentic era before the next spiral begins. The SEC is exploring mandates for explainable AI, requiring models to provide a human-readable audit trail for every trade. They are also considering kill switches to manually disconnect algorithms when they begin to hurt. But these rules are being written for a market that is already almost entirely digital. The chaos of the 2010 trading floor has been replaced by the quiet, cold logic of server farms. These machines are flawlessly logical, but they are also blind. They can optimize a portfolio for a 3% gain in a millisecond, but they cannot comprehend a society that can no longer afford to buy what they sell. The question isn't whether AI is smart enough to run the market, it's whether a market without humans can actually survive. Will AI save our economy or simply automate its collapse?